So you're thinking about investing in gold, or maybe you are invested in gold, or maybe you're on the fence about it. This video is hopefully going to educate you to make sure that before you invest in gold, you're fully aware of all the things that you should be considering. Because what we don't want to see is that somebody purchases something and then regrets it later. So what we want to cover today is we want to cover the recent performance of gold compared to something like the S&P 500. We want to also compare its volatility to something like the S&P 500 and know what the risk is. We want to look at the cost of owning gold. We want to look at the tax treatment of owning gold. By understanding these things, I think you'll have a better idea if it's worth owning or not. And ultimately, we want to discuss the benefits versus the cost so that you can make your informed decision and make sure that you're living your best retirement. Let's first start why many people consider gold. I think what makes gold the most attractive for potential investors is the fact that it performs so well in times of economic uncertainty. It has an emotional appeal to it to know that it will always hold value regardless of what's happening in the outside world. Now, what we also want to keep in mind is that gold is a commodity. Much like any commodity, the way in which it derives its value is through supply and demand. It derives its value through scarcity. Now, new gold is mined every year, but the supply itself is not really a significant number. It's the demand that more or less will drive the actual cost of gold. And if we look back to the late 70s and 80s, you shouldn't be surprised to see that demand really peaked up in times of economic uncertainty. In the late 70s and early 80s, we were experiencing stagflation, times of economic growth that was really slowed, and high inflation. You may also remember the oil crisis of 1979, which again further drove economic uncertainty. But in the 1980s and 1990s, economic growth boomed under the Reagan and Clinton administrations. And that period of time led to a lot of high consumer sentiment and confidence. Yes, there were certainly blips along the way, but for the most part, those 2 decades were met with positive economic news. It wasn't so positive, though, for gold, as you can see in these returns. From 1983 to 2004, gold really lagged, and it had many down years, including several down years in a row. It really began to pop in the mid-2000s when the subprime mortgage crisis was taking place. It really began to hit its peak up until about 2011 to 2012. During COVID, gold again began to shoot up. And in the past year, 2024, it had again a record year. So as you can see, gold's history in the last 40 years has been up and down. It's had periods where it's done very well, specifically in times of economic uncertainty. But when the economy is booming and the stock market is doing well, gold hasn't just lagged behind, but it's actually been negative. Which brings us to our second point, that despite it being considered a safe haven for many investors, gold is surprisingly volatile. If we look at a chart using backtest by Curvo, what we can see is in the previous 30 years, we can look at both the performance and the standard deviation of both the S&P 500 and the spot price of gold. You are going to see peaks and valleys in both the S&P 500 and the price of gold. But as you can also see in the last 30 years, the S&P 500 has pretty significantly outperformed gold. But what we also want to keep in mind is that gold has still been risky. One of the measures of risk is standard deviation, and standard deviation will measure how much an asset's return deviates from its average return. That way you can get a feel for how volatile and consistent that return would be. The higher the standard deviation, the higher the fluctuations and the risk that you'll feel. So if we look back in the last 30 years to the S&P 500 and the spot price of gold, the numbers are very similar, but gold is just ever so slightly riskier, or at least has a higher standard deviation than the S&P 500 does. So again, I think the emotional appeal to a lot of investors can be felt that when the S&P 500 is crashing, which it's had a tendency to do at times in the last 30 years, gold has been that place, that safe haven that investors can go. But you have to keep in mind that when gold is rising and the stock market is crashing, yes, it's going to feel good then, but what happens when the stock market rebounds? The price of gold generally has also seen drops, and significant drops. But something that we also need to keep in mind is that the tax treatment and the cost of gold should also dictate if you're going to decide to invest in gold or not. It is important to note that there are a number of different ways in which you can invest in gold. The 2 that I want to cover today are to either choose to invest in a gold ETF or exchange traded fund, or to actually buy the physical gold itself, whether that be gold bullion, gold coins, however you decide to go about purchasing physical gold. Let's first start with the actual cost of owning gold. So if you decide to purchase a gold ETF, much like you would notice inside of a mutual fund or another exchange traded fund that had something like stocks and bonds, there is an underlying expense cost to this. Generally, the cost can be anywhere from 10 basis points to 75 basis points. A common one, and this is just shared for example purposes, is the IAU, or the iShares Gold Trust Fund. This has a cost of 25 basis points per year. So if we look at it from the perspective of owning a gold ETF, It's really not that much different than holding an ETF that has other stocks. The difference, though, would be if you decide to purchase physical gold, because purchasing physical gold usually will carry with it some level of a premium. If you're planning on purchasing gold, you can expect to purchase it at 5 to 10% higher than the spot price would be. If you're planning on selling that gold, expect to sell it at 3 to 5% lower than the spot price would be if you're using an authorized dealer. If you're planning to sell it at a profit, just note that there's going to be a cost of both buying and selling gold. But something else that should be considered if you're planning to purchase gold is the tax treatment of gold. We recently did a video that showed how you can really live off retirement income if you're able to smartly utilize long-term capital gains. But when it comes to precious metals, they're treated as a collectible, and collectibles are taxed differently than investments would be taxed. Collectibles, instead of receiving the tax treatment that normal capital gains would receive, they're taxed at 28% of long-term capital gains rates. They also don't have the favorable brackets that long-term capital gains have. So understand that if you hold this gold for longer than a year, you could be subject to these higher capital gains rates. If you hold it for less than a year, it'd be subject to the short-term capital gains rates, otherwise known as your ordinary income rate, in which case it could be higher or lower than that 28% depending on where you fall in the bracket. But one other thing of note is that you might decide to own a gold ETF within an individual retirement account, an IRA or a Roth IRA, in which case it would receive different tax treatment. So it's an important disclaimer to understand that if you're not planning to actually own the physical gold, in that case, you'd be able to utilize these at more favorable tax rates. So should you decide to own gold? We do receive this question quite a bit, and it shouldn't surprise you, but this question often comes up during times of volatility. And yes, you can look at a return in 2024 and in hindsight say it would have made a lot of sense to own gold. And if I had to guess, we're going to see years like 2024 again, in which gold shoots up in value and investors in gold are very happy with their returns. But when you do compare it to something like the S&P 500, again, it does lag behind. The other thing that we need to keep in mind again is the actual cost of owning this gold and the tax treatment of owning this gold. If you decide to purchase gold, it is a good idea to make sure that you're not over leveraged. We want to make sure that a retiree has everything else done properly, including that they have an income plan in which they're able to make sure that they consistently have positive cash flow. They're also invested properly and allocated properly. And we also want to make sure that their tax plan makes perfect sense and that they're paying their fair share, but nothing more. Just keep in mind, though, there are also costs of owning gold. And yes, it will perform well in times of uncertainty, but in times of certainty, it has lagged behind, and you need to make sure that you factor that in if you're planning to own gold. If you found this video insightful and this information helpful, please consider subscribing to the channel. We release one video a week in which we cover topics that are related to you and your retirement. You can also check out HyperionFP.com if you'd like to learn more about my team and I. But more importantly, if you're interested in learning about retirement, I'm linking to 2 videos right now. This first one's going to give you a better idea on if you should or should not collect Social Security early. And this next one here should give you an idea of some things that you consider in a down market environment.